Right. Thanks for joining us. I'm Adam Jackson. I'm Director of Policy at Innovate Finance, the champions of fintech in the UK. And today, maybe for a CogX first, we're going to be talking about central banks. But before you kind of make for the exits, we're going to be talking about how cryptocurrencies, digital assets, and crucially then the adoption of a central bank digital currency impact on the role of banks. But we're going to talk about people, we're going to talk about the economy, we're going to talk about kind of the impact on the real world. I'm also a member of the Bank of England's Central Bank Digital Currency Engagement Panel, which is advising the Bank and Treasury on plans, taking a decision, yes or no, whether to proceed. And we've got kind of various other Bank of England components. So Ashley, who is digital finance expert at the IMF and previously led World Economic Forum work on digital currencies. Ashley is also a member of the Bank of England's CBDC, Central Bank Digital Currency. You're going to hear that a lot. Technology Forum, so advising on the technical aspects. We have Lovell, Head of Future Technologies at the Bank of England. So Will looks at all future technologies, including distributed ledger and AI.
That's right.
And just to keep us all honest and kind of challenge us, we have the one non-Bank of England affiliated person, James Pomeroy, who is Global Economist at HSBC. So James advised both the clients and HSBC as a whole on world economic trends. I thought at the start we should probably do a bit of definitions and scene setting. So just sort of the first question, CBDC, or central bank digital currency, just how would you describe it? Is it digital cash? Is it something else? Ashley, what is a CBDC?
Hello, everyone. Nice to see you all. So I like to describe central bank digital currency as regular citizens having accounts directly with the central bank. That's one way to think of it. So rather than having your account with HSBC, it's at the Bank of England. And it gets a little bit more complicated in reality as the ecosystem has evolved. You might have an account at HSBC, which then backs the assets with the central bank, but and it might not even be an account, it might be a token, but it effectively accounts directly with the central bank. And it sort of has four key definitions or components to the definition. One, it should be digital. Unlike the physical cash that you use today, it's central bank issued, but in digital form. And it's issued by the central bank, and it's a direct liability of the central bank, and it's accessible to the general public. So it's basically the physical banknotes meets digital money. It could look very similar to the money, effectively be the same as the money that we have and use today. It could be in a mobile phone wallet, again, in a bank account, but it's actually backed with the central bank directly and fully. It could be in a stored value card. The key difference, which is something that you wouldn't notice on a day-to-day basis, is that if there's an issue with the issuer, with the payment service provider or the bank, the central bank's going to backstop it, and it can guarantee liquidity, transaction finality, redeemability in a way that no private sector entity can, because the central bank can print and is supported by the government. So it provides that safety, and that's basically what a central bank digital currency is.
That's sort of the critical element. You might access it in different ways. You possibly won't access it directly from the Bank of England, but at the end of the day, you have that central bank backstop. Whichever country it's in, the central bank will guarantee that you can redeem that. That's the focus in the digital world. So, Will, how does that differ from, and we get into sort of further terminology, a central bank regulated systemic stablecoin? So if you're like a kind of, a private sector,
sure.
So maybe not Tether, but kind of we know the bank in the UK and others are looking at providing, if you like, sort of central bank guaranteed stablecoin provided commercially. How is that different to a CBDC?
So let's unpack those two terms first. So a stablecoin is, if you like, a digital asset that is backed by something close to a fiat currency. And in the case of Tether,
Fiat currency is
being
like
a normal sort of banknote that's issued by a central bank, that kind of money. The case people normally talk about is Tether, which is tethered to the US dollar. And what we've learned recently is that some of the assets that they were actually holding didn't quite have the same value as dollars. So there's this question about whether the stablecoin is actually stable, whether the assets that it's based on are as stable as they should be. A solution to take that and make it stable is to actually use reserves in a central bank, which is the ultimate risk-free asset. It's the same as having a banknote in your hand. And once you start to do that, the stablecoin starts to become a bit more like a central bank digital currency. And from a user's perspective and from a consumer's perspective, it might look exactly the same. But just picking up on some of the things that Ashley was speaking about there, at times of stress, suddenly things start to potentially look a bit different. When people start to question and want to realize their money, change it into a different form if they find that they can't. That's where the regulatory model, were we to do this stablecoin thing, would need to be really, really strong.
So, does that say there isn't fundamentally, there may not be a huge amount of difference between a central bank digital currency and a central bank regulated stablecoin?
From a consumer's perspective, maybe not. From an economic perspective and from an accounting perspective, they are quite different. Because you have, in the stablecoin example, you have a private company, and effectively their balance sheet and their solvency is in the way. In a central bank digital currency, you're dealing direct with the central bank, which is ultimately certainly a public entity and is set up for the public good rather than a profit-making entity.
So the commercial one, a lot of the risk has been taken out because they're required to maintain very rigorously assets, but there's still some risk there.
Exactly.
Gotcha. Brilliant. And I can come on to James in a minute, but in terms of central bank digital currencies, is this all future stuff, or are there some out there at the moment? Kind of looking around the world, what does it look like?
So we'll start with the UK and then we'll move around the world. In the UK, we are minded, the Bank of England is minded to introduce a central bank digital currency, which might be the most British thing anyone's ever said. But what that means is we haven't taken a decision yet, because in an economy like the UK with a mature payment system, it's quite a finely balanced decision, but we're working very, very hard on it, and that's what minded to decision means. Elsewhere in the world, it looks quite different. China is an example a lot of people give. They are running a pilot of the digital yuan, although it's at a scale of, I think, 100 million users. So it's a pretty large pilot. I think that's a sort of response to the private payment systems, Alipay and WeChat Pay. So that's quite specific to how their economy works. Likewise, you see things like the Sand Dollar in the Bahamas or the e-Naira in Nigeria. In more developing economies, there's an opportunity to leapfrog, if you like, straight to the latest technology. In places where there maybe isn't a huge bank population, where there maybe is not a very mature payment system, they're actually jumping straight to the latest thing, which is very similar to what we saw with telecoms in the 1990s. Digital mobile phones, for example, were available in Nigeria before they were in the UK. So there's a lot of activity, but I think it reflects the local conditions, if you like. It's quite different depending on where you look.
Yeah, and I think that's the challenge for the UK of we've got a very established system, albeit we've also had huge amounts of innovation in payment systems. Kind of whether we build on that or whether that sort of accumulated stuff gets in the way. And what you've talked about there is particularly kind of looking at domestic markets, I suppose. And that maybe brings us just to the difference between a retail central bank digital currency and a wholesale one. You hear quite a lot about retail and wholesale. I think we're going to talk about retail primarily, but James, just again, final definitional question before we then get stuck in. What's the difference between retail and wholesale in this context?
So in very simple terms, a wholesale CBDC operates in the background, almost between banks, in the system that most of us in this room would never ever see. And you will have no idea this thing exists. We could have wholesale CBDCs and most people in this room wouldn't have a clue at any point in their lives that this is what technology is behind the system. A retail CBDC could end up being exactly the same, as we've just heard. You could not notice that anything has changed behind the system. But there's many more decisions that have to be made in the design of a retail CBDC that could have big economic implications. And I imagine that's what we're going to talk about in terms of how anonymous they are, in terms of interest rates, all of these things. And that's why they're much more exciting to talk about, both as economists, but also for the general population, because that's where you could see some of the implications on the retail side.
The wholesale is kind of just shifting money between banks or large corporates.
Pretty much, yeah.
So that there's probably less of the kind of innovation in then, the add-ons,
it's a different sort of innovation.
Exactly.
Yeah, in the wholesale space, people are looking for, the large banks are looking for efficiencies. They're looking to reduce their risk. I would say it's very exciting. I've spent a lot of time in wholesale payments, but it's a different type of innovation and it sits in a different place.
Well, one thing that the two do have in common, to the point, is that it's all about cutting wastage. It's all about efficiency. And going back to the very, very first question, that I'd sum up as CBDC is the perfect means of payment. And if you could say to someone, we can have something that is incredibly secure, pretty much costless, and available to everybody, then you're saying, well, how could you beat this? You can't. And that's essentially the journey you're going on. And all of this is about cutting out wastage, making the economy more efficient, both in the wholesale stage and in the retail stage. And if we can do that, that's really good news. We need some good news in the world at the moment. And yes, this isn't going to happen immediately, but anything that cuts wastage out of the economy is a good thing.
So is that the primary, moving on to kind of benefits, use cases, is that the primary benefit of, and if we focus on a retail CBDC, one that we would use as consumers, is it just about being cheaper than using cash or any of the other payment systems, digital payment systems we already have?
I wouldn't necessarily say it's the sole reason, but every different government or every central bank has their own reason for bringing this in. So we've heard about what's happening in China. It's because of competition from in the private sector that could create financial stability risk. One of the great examples, I think, is in Sweden, where the Riksbank said, well, cash isn't really used in our economy. So we don't provide, as a central bank, a means of payment that's both universally accessible and universally accepted. And that is a fundamental problem we have to fix. So that's why they're interested. So they're looking to provide a means of payment that is both of those things. Other places, most of the emerging world, the advantage is about getting people banked. Now, if you can leapfrog the technology, get people connected to bank accounts, get people access to savings, to investments, to credit, all of these things, that's really powerful as well. So I think it does depend on where you are in the world. There's a lot of different reasons to go down this path, but in all cases, what you're trying to achieve is a better financial system that allows the economy to work better, that probably raises your potential growth rate as well.
So you touched on their kind of being able to give people who don't have currently access to banking, actually enabling access. That's one of the benefits people sometimes talk about. Does this enable financial inclusion? Ashley, is that a benefit? Is that are there real, is there a way of kind of bringing that to life of how it could tackle financial exclusion, or equally, is the flip side that it could make things worse?
Yes, it's a very complex issue, and as was said, the emerging economies are really excited about financial inclusion with CBDC. They have a lot of populations who use a lot of cash, who don't necessarily have bank accounts, who might not even have mobile money accounts. So the question is, can CBDC do something better? And they're hopeful and currently evaluating, I would say 80-90%, are evaluating whether CBDC can help improve financial inclusion. And so the key question has to be, what are the drivers of exclusion in the economies today, which could be lack of digital identity so that people can't get onboarded with compliance requirements for the banks and other services. It could be limited internet, limited mobile phone, either feature phone or smartphone access, which is where people can get to accounts. It could be lack of this first mile, last mile digital infrastructure, or the on-ramp or off-ramp to move from cash to the digital money and move from the digital money to cash, or for payments. low digital and financial literacy, and high fees and costs. So it could be the case that central bank digital currency addresses 1 or 2 or 3 or 4 of those, or it might not, and it's a very local situation. So at the IMF, a lot of what we're doing is working with the developing economy central banks to do that assessment and evaluation, but also to make sure that the ambition is realistic and that things don't go wrong, as was alluded to. So it could be the case that you create more exclusion or widen a digital divide if you develop a solution that's only accessible to people with smartphones and steady internet who are very savvy. Then it doesn't solve a problem, right? And inequality and access to financial services could widen. Could also be that tourists aren't able to use it, or other risks and challenges get aggravated. And we haven't even talked about other downsides and challenges and risks to CBDC, not about financial inclusion, but financial instability. But that's a quick take.
Come on for that.
It's a two-sided opportunity and risk with a lot of factors to consider. And just as with digital currency and cryptocurrency claims about financial inclusion, it's important to move past the broad claims and really study why people are excluded in the economy and what's different and additive about the tech.
So I guess, I mean, you kind of look at the history of money, and it sort of took hundreds of years for systems of coins and banknotes and then digital payments to gradually be introduced. And what we're sort of talking about is potentially a kind of revolution much faster than that, but therefore all of the issues that might have been worked out over a long period of time have got to be looked at upfront in the design, I suppose. And as you say, things about geographic access, technological access, physical kind of ID, they all need to be
and risk management
factored in. Yeah. And is one thing I've sort of picked up, and the work on the Bank of England engagement panel is there's sort of a debate of, is this just a cheaper version of what we can already do, or does it potentially create more innovation? So people talk about cash that's programmable, that you can kind of build rules into or systems, and instant payment versus there always being a delay, and being able to make micro payments that, because it's so cheap, you can, potentially, I don't know, you could go around paying for each item as you scan it in the supermarket rather than waiting until you get to the checkout. Does anyone else want to say anything about those sorts of benefits? Do we see those being the kind of innovations that will really make it take off for consumers?
I think there's a potential for it. I think it could take some time. If you look at electronic payment systems around the world, and this is true in the UK as well, they've evolved, and they've evolved from paper-based processes. We've taken paper-based processes and we've turned them into electronic processes. We now actually have an opportunity to start again, and I think we would be crazy not to take that opportunity. And when you start to look at some of the things that can be done with what's called smart contracts, where effectively you can program rules around money. You look at some of the more innovative things that's being done in the crypto space, there's a lot to learn from that. It's not a case, I must emphasize, of just taking that and just dropping it on top of central bank money. But it's a case of understanding what that technology can do and saying, how could we use that? I think that then needs to be balanced against the risks. To Ashley's earlier point, don't break anything. The Silicon Valley mantra of move fast and break things really doesn't work here. But we would be remiss not to look at that opportunity. But it will take some time to come in. It would be my prediction.
Can I just pick up on a couple of things on this? I think it's really interesting. As an economist, a lot of things around CBDCs and these possibilities really excite me. So firstly, you've got the idea of programmable money in terms of handouts. We've seen during the course of the pandemic, instant payments to households can have a transformative effect on the economy. But what happens if you can tailor those exactly as you need to in real time? So right now, if the UK government wanted to go, your fuel bills are up, here's some money, can only be spent on your fuel bills. It makes the application of certain types of fiscal policy potentially, and there's a big risk around how you do it, considerably more efficient. And that excites me as an economist. The other part of this is what happens if you limit what people can or can't do with their money. Now, this is where people get scared. And I completely understand why people get scared. If I've been to McDonald's 3 times in a week, my card suddenly doesn't work, right? Whilst you can argue as a really sort of utopian economist, this is for the greater good, you can also say this impinges on people's freedoms. But this also plays into the broader question around how anonymous a CBDC is. Because you can essentially pick the whole spectrum, from just completely anonymous like cash, through to the central bank or whichever government or authority you want can see every single line item of consumer spending in a given minute even. Now, I get why people would be horrified by this. Completely makes sense to me. But at the same time, as an economist, I'm sat there going, well, imagine if you had all that data. We could set policy so much better. You know, if the central bank knew exactly what was happening in the economy in real time, we could set interest rates to just be a formula. Now, it would automate away a considerable part of my job. You know, this is actually progress in this sense. But I completely get why people are scared about it. But at the same time, there is a beautiful macroeconomic utopia out there that we're not going to get to. But we're going to be somewhere between those lines. And where we end up is a decision that every central bank's got to make.
So almost that starts to join up thinking about crypto and digital currencies with the debate about data and AI. You know, I think often we sort of look at those two separately. We think about there's open finance and data and application of AI, and then there's cryptocurrencies. And actually what you're saying is, particularly with a CBDC, it starts generating huge amounts of data, or you can use data, you can apply algorithms, but that then takes us bang into the debate of how is it used?
Yeah.
And I guess particularly how are individuals protected and privacy issues. Ashley, is that kind of the biggest risk, do you think, the privacy question in the long term?
To CBDC? There's a lot of risks, and I mentioned financial instability, and James could talk about that more, but that's basically that banks don't have any more deposits or have fewer deposits because now we're all holding CBDC accounts, and thus they can't provide as much lending in the economy because the deposits are their cheap funding source for lending. There's various ways to mitigate that risk, but that's a big one, or that suddenly in panic crisis situations, people pull their money out of the banks. Then that not only creates that loss of deposits, but also just instability that can shake through the economy. But on the privacy side, this is an important policy question and issue, and there's maybe 3 key items to unpack at first. One is that it's about protecting from the authorities, but actually even more so perhaps protecting and shielding data so that if there's a breach or an attack on the CBDC system, that all the people's data and funds aren't compromised. So that's one of the reasons why cybersecurity is one of the fundamental, key foundational requirements, good cybersecurity for CBDC. But you can also mask to protect the funds and data. But also, trust and adoption can be higher if there's good privacy, if people are confident that they're not being spied on when they go to McDonald's 3 times a day or whatever it is. And privacy preferences change around the world, and they're different all around the world. So in the Euro area, the ECB did a survey recently, and privacy was the #1 priority for the citizens surveyed. I think it might have had a little sample bias in Germany specifically, but 43% of the respondents said privacy was their #1 concern, followed by security at 18%. And so that looks different all around the world. And there's different ways to provide the privacy. I mentioned masking techniques. There's different hardware and software privacy-enhancing techniques that could be used. One that's discussed pervasively, it's also discussed a lot in cryptocurrency, is a cryptography approach called zero-knowledge proofs. And what that does is it makes it so that the information is masked, but certain details can be revealed about it. So you can ask, is this account balance greater than $10,000? And it won't tell you the balance, but it would say yes or no. And what that means is that A certain interest rate could be paid if it's greater or lower than $10,000, probably higher if it's lower, because you might not want people to have balances that are so big, because then we get into that financial disintermediation issue. It could be that if people have low balances, they get some government subsidy, because maybe that indicates that they need the funds, or different things like this. But there's always trade-offs in life. So these privacy-enhancing techniques are generally accompanied by slowness, so it takes the transactions longer to happen, and they're more computationally intensive, so the costs could be higher, and that's the same with their use in cryptocurrencies. And then lastly, we have these computational techniques, but we also just have different ways to structure who sees the data and who doesn't see the data. So it could be that the data is masked from the merchants, and that's what China does. So China has a late-stage pilot for CBDC, the digital yuan. And what they do is that the users have pseudonyms, and when they're buying things or paying someone else, then that person just sees the pseudonym and they don't have the person's identity. But the Central Bank of China has the information that can map the pseudonym to their identity. So they see everything. And that meets the requirements in China. And the different preferences around privacy. And then the last point I'll just say is that it's really important, as with cryptocurrency, to keep in mind illicit activity risks, and that a key reason to have some data is the prevention of money laundering and terrorist financing, and major guidelines around the world, including those from the Financial Action Task Force, basically would make it not advisable, seriously not advisable or not allowable to have fully anonymous accounts.
Thanks. So, sounds like given all of that, we need specific rules for cryptocurrency. It's kind of, we can't just apply existing data privacy. It's going to be a matter of looking through the issues.
Well, existing data privacy is a good place to start. And I think it's worth remembering, even in the UK, electronic payments have already overtaken use of physical cash. And that happened, I think, 2016, early 2017, something like that. So it's a pre-pandemic phenomenon that's just accelerated. So most people are paying with either contactless or cards or something like that most of the time. And they are leaving some data behind when they do that. And I think most people have a reasonable understanding of that trade-off between the amount of data you need to share to get the benefit that you want versus something that's excessive. The actual tighter definition of that is going to take more work. But the actual concept is out there already. Pretty much everyone in this room will be sitting here with a smartphone that's broadcasting various bits of information about their data that's being picked up, and we accept that trade-off for the benefits of having a smartphone. So I think if we can think about that in that context, that will help us to find the right point between preserving people's privacy and having the information that we need to be able to counter crime and the like.
Super. I think we're going to take questions now, but it just strikes me from what we've heard, really interesting that it always feels a central bank digital currency is kind of inevitable for all the minded to, and we're still taking a decision. There's a sort of inevitability about it, but it raises a whole bag of issues. They're kind of the issues that we've seen in the economy and society for the last few years, but it kind of condenses them all. There's kind of questions of competition and private versus state, big tech or dominance of a few players versus diversity in the market, financial inclusion, privacy against, particularly with this, then government as well as the commercial sector, and then kind of crime, security, etc. And it's kind of all bundled in, and it's interesting that I don't think the Bank of England in ordinary times or previously would have necessarily been looking at that whole bag of issues, quite a lot of it, but particularly starting to look at privacy issues as well as everything else. And for the techs, they're having to think about financial stability and a whole set of issues as well. So I guess there's just a richness of complexity, but the benefits are kind of the prize that's driving.
Definitely, but that's why we have the engagement forum and the
Yeah.
tech forum and the task force going across UK government as well, that I think it reflects just how broad a subject it is.
You said, just before we came on, big
dear.
challenge is going to be communicating and engaging with the
Definitely.
public. At Innovate Finance, we flagged that's probably the biggest issue of just engagement. So as a way of starting that engagement, albeit with some experts out there, we've got questions. So I'm going to go for the lady in the polka dot top first, and then the gentleman behind her after that, and then we'll come to two people in the front row.
Awesome. My name is Cameron I'm from CoinDesk. So James spoke about how CBDCs could perhaps help the welfare system and ensure that funds are given for specific causes. I'm curious to hear from Will if a UK CBDC would be used for that purpose. If not, what purposes would a CBDC issued by the government serve and to whom?
Right.
Okay, so first and foremost, I don't want to tell anyone how to spend their physical banknotes. We don't do that now. And I've got no intention of telling people how to spend their digital currency either. That's not something that we're researching at the moment. The technology clearly allows it, but that's not on the list of what we're looking at. I think, to pick up maybe the second part of your question, who's it for? Well, as we've heard, there's a financial inclusion point, there's an innovation point. I think there's also a recognition that the economy is changing, goods and services being traded online that just didn't exist when most of our current payment methods were invented. If you think about a payment, it's only ever 50% of any story. There's always something else moving in the other direction. And we're probably due rethink, if you like, of how our payments work to see if it reflects that as well as it should do.
And just, I guess the other question is, so the bank isn't going to sort of tell people how they can spend their money. James's version has maybe the state possibly doing that. I always have this example of, well, kind of one benefit could be if you were, I don't know, a grandparent giving their grandchildren some money for Christmas. And at the moment, you give them some cash, you don't know what they're going to spend it on, but potentially you could program it, so I don't know, it can only be spent on educational material or can't be spent on booze. James, is there a kind of middle way between Big Brother state and you can spend your digital cash?
But this is it. There's a whole spectrum of decisions you can make, right the way through from completely anonymous, which, as we've heard, has its own problems, all the way through to you can do every single bit of programmability or tracking, which has its other problems. And every central bank has got to decide where you sit in that spectrum. And that's what takes time, because there isn't a right answer. You could put all of the smartest minds in the world in terms of payments, economic policy, all of these things in a room, and they will not agree on what the right answer is. And so some central banks are going to have to take a bit of a gamble, I think, and essentially go, this is what we think the answer is, but is it? And actually, that's why a lot of central banks, I think, are being a little cautious about doing it, particularly in the developed world, because you don't want to go first. Because if you go first, you're the one who's got to take a bit of a gamble. So I keep saying to people, have a look at what's happening in Sweden, because they're the developed market furthest ahead on this. And what works in Sweden may well work in the UK or the US or the Eurozone or wherever, because they're probably similar-ish types of economies compared to, say, China or some of these emerging markets. So it's worth keeping in mind, and what others do, whether that works, could well inform the thinking of other central banks. But there is not a right answer, and that's why it's so complicated.
There's a phrase you don't often hear, central banks should take a gamble. We've got another question. The guy with the beard behind the previous question. And then I'll come to the two at the front row.
Hi, I'm Joshua, and I'm coming from Spool. Basically, we're a DeFi protocol that offers exposure for clients, permissionless exposure to stablecoin portfolios, yield-generating stablecoin portfolios. So this is really interesting for me. I do want to ask, obviously there's two different adoption curves right now. There's one which is decentralized stable currencies, which is more gradual, but still arguably going up. And then there's obviously the centralized digital currencies, which will be much more steep and hasn't really begun yet. How do you see these adoption curves sort of playing out over time? Do you see them sort of combating each other, in any way complementary? Just as a bit of reference, there was a BIS summit on this maybe about a month ago, and there was a really interesting conversation on there where they mentioned CBDCs might end up being integrated into DeFi systems. I don't know if you have any thoughts of that.
And James or Ashley, and I guess this is the big question, are central banks doing this just so they can kill off stable coins and cryptocurrencies, or can they live harmoniously together?
I'll give a very quick answer. Essentially, if we go back to what we were saying earlier, a stable coin still has an element of credit risk. But if a central bank issues a CBDC, there is no credit risk. So by default, it's better. So surely, to me, the end game is CBDCs, and stable coins have a much more niche use case. But going back to what I just said, that runway for central banks is an unknown period of time that's probably quite long. So there's almost a big, fat air gap for other payments products to exist in and maybe to grow and maybe actually end up evolving in a way that means they become much more complementary around a CBDC. But that's my sort of quick answer.
Ashley, is it?
Yeah, and as James was saying, I think they serve different purposes and they serve different audiences, but I think there are a lot of reasons that expecting a wide amount of payments or heavy adoption of cryptocurrencies, including stablecoins for payments, which may not be what you're asking about. I think you're asking about general use, but that challenge the use of payments. So, if it's a cryptocurrency where the value changes, there's capital gains taxes every time you buy your coffee if the value has increased. And the fact that the price moves make it so that you might not want to spend. There's transaction fees, and this is the same for stablecoins as well, because you have to pay these validators who are otherwise uninterested and generally only profit-seeking. So they want to get paid for their validation activity, which is expensive by design, so that it's expensive for them to attack the network. Bitcoin has had transaction fees ranging from $1.75 to $60 this year. Within the past year, Ethereum $1.60 for a basic transaction to $75. And then there's other challenges depending on what the underlying consensus algorithm is, which you're of course well aware of. But if it's a proof of work algorithm, which is what Ethereum currently uses, and Bitcoin and many other major cryptocurrencies, there's significant costs, as I think is generally understood, but maybe not the degree. So for one Bitcoin transaction, that has about 1 or 1.2 metric tons of CO2 footprint, which is the same as going from London to Addis Ababa, Ethiopia, or from London to Washington, D.C. for one payment. And that's also 1,000 to 2,000 kilowatt hours of energy, which is one US household for 1 to 2 months. So these need to be factored in, their negative externalities.
So it sounds like quite a challenge long term.
That's right, yeah. Some people would say that it is, and I guess I was responding to the question of these are challenges that would make it pervasively adopted for payments.
Yeah, and I mean, go back to your point about the ultimate form being the CBDC. I think the very act of or nearly anonymous or just sort of decentralized or permissionless access to these payment channels is the thing that keeps people there, not necessarily the efficiency, certainly not the transaction fees, because anyone that uses Ethereum knows that's not good. It's not just the ideology, it's the freedom that it gives you as a person. And I think that's something that's the conflict I'm more interested in.
Yeah.
Is that something that is going to be unacceptable in the CBDC universe to have these permissionless, almost anonymous payment networks?
I think they can exist, but they're not as widespread. So my sort of simple logic of this is that when you get to widespread CBDCs, that is what becomes the widespread means of payment in society. It's not to say that other means of payment can't exist. Stablecoins will exist, and they will be used in some situations. Particularly, there's a lot of people who won't want to use CBDCs for the various reasons we've discussed around privacy and all of those things. And stablecoins will have a purpose. But in terms of that broad, the underlying means of payment in the economy, I find it hard to see how it could compete with a CBDC because of the additional benefits you get in terms of security, cost, etc. So both can exist, but a CBDC more likely to be the widespread use case.
Have we got time? Can I take the 2 quick questions at the front? They answer your gentleman here.
My name is Deepak Parmanand. I work for JP Morgan. My question is on financial inclusion. I've heard that term being used a lot. I want to understand for who's that mythical creature we want to do financial inclusion for, because I've seen, you must have heard of UPI in India. They solved financial inclusion by making it SMS-based, literally the last mile connectivity, and they included everybody. Now when I contrast that against the consensus algorithm, the stablecoin, the USD, the GBBT, the EuroDT, the USDT, all the complexity of everything. So who is the mythical creature we're doing financial inclusion for? Is it the teenager who is looking at dad's money? Is it the retiree who's trying to get access to the money? Or is it the poor who don't have access to the smartphone? So who are you solving it for? And how do you look? How are you going to overcome the cognitive generational knowledge of passing money around? And how are you going to change that with all the complexity of a crypto digital banking world?
So, Ashley,
I also,
Will?
yeah, I feel I've been speaking a lot. So,
So my way into that question, first of all, is to look at what is already happening, the trend that is already happening. So, and you'll see it, a few meters away from here. Stores are no longer accepting cash in a lot of cases. They just don't have the infrastructure to do it. And as that spreads, and we see that even more in Sweden and Norway as well, that excludes people who don't have a way to pay. It's not a huge issue in the UK yet, but it's something we need to get out ahead of. Likewise, how do you transact online? And as more and more services start to move online, that's something that we have to tackle. So, as I say, my starting point is that this is going to happen whether we like it or not. I think it then takes you out into some of the use cases that you've talked about, for example, giving money to children and so on. This is where we need to start looking at form factors. It can't just be a smartphone. What other sorts of devices do we need to include? What happens in the event of telecom failure? What happens in the event of power failure? There are lots of different scenarios. But as we start to sort of work through those, I think we'll start to include more and more people. But as long as people want banknotes, certainly in the UK, we'll be producing banknotes. This is not a sort of let's get out of the banknote business for us. This is about recognising the change that is happening already.
Thank you. Got time for one more question. Excellent. Exactly.
Hi, it's Nick Kerrigan here from Swift. One of the things that when we think about CBDCs that we're particularly focused on is interoperability, because if you accept CBDC are going to happen, and it sounds like from the panel there's an inevitability here, they're going to have to coexist alongside existing payment system potentially for many years. So I'm wondering how the panel thinks about the challenge of interoperability and what might the solutions be.
It's probably one more so for the other guys, but it's just something that what we're seeing and where we're looking at sort of what's happening across the world is the central banks at the moment are focused on solving the first problem. And solving the first problem is how do you design this thing and all these questions we've answered. And then you suddenly go, well, what do we do next? And that seems to be the secondary consideration, and that feels even further away to me. And a lot of central banks at the moment are very much focused on their domestic payments. How can we get that right? And then the next step will be thinking about international payments. How can we use CBDCs across borders? There's some pilots going on across the world on this front as well. So we'll get there, but it feels to me feels a little further behind than domestic payments. But these
so I think in interoperability. So this is another maybe we should have covered in the sort of definition of terms section, because there are so many different ways to think about it. I think what you were talking about there is just within, in my case, sterling, and just within the existing banking system, current payment system. Yes, it's right up there, very high on our radar. For the starting reason that people have got to get into CBDC. How does the first person get their CBDC? You've got your money in a bank account. How do you flip it in? Or you've got some physical cash. How do you transfer it? So there's simple questions like that. There are then more complex questions that, if we're saying, as we are, that £10 of CBDC is the same as a £10 note, then you need to be able to move in and out of between those mediums in as simple a way as possible, a friction-free way as possible. Because otherwise, what you then start to see is that you'll maybe get a sort of difference in the way that people are valuing it. And in the same way that actually we have, again, a very well-functioning teller network that we almost don't think about, that allows us to move out of what I call commercial bank money, the money in your bank account, and into physical cash, and back again We almost don't notice it, but that's very carefully designed, and it will need to be thought through and built into a CBDC for sure.
Thank you. We're going to wrap up there. I think just in conclusion, it's really interesting. We've seen the kind of different components of change happening in the economy, and we don't quite know where it's going. And we have some indications of, there's a world of crypto, which I think was described as, for the sake of freedom, actually people are prepared to pay more for anonymity and benefits around that. There's a world that says this is all going to drive efficiency, and you can see big tech and big banks kind of moving in and thinking about kind of dominating the space. And we've got central banks worrying about stability, maybe sort of on the one hand, public policy issues, on the other, verging into, in some markets, maybe kind of more totalitarian applications. And there's kind of a whole load of possible futures. We don't yet know where they are. And I think the other thing that stands out is in different countries, the approach will be different. We need interoperability and ways of linking those, but at the same time, the precise solutions will depend on what the big issues are in individual economies. So it's kind of an incredibly complex area. It makes it really exciting, amalgam of technology and policy and economics. But it's going to be a topic to be discussed ongoing. My final thought would be, I'd sort of talk about a digital democracy. So, can we, in those sort of possible futures, can we aim for a digital democracy, which is kind of a diverse, competitive market that protects consumers? And maybe a key part of that is just having more discussions on central bank digital currency and crypto more generally. So thank you for participating in that, and I look forward to further discussion through the day and through the months ahead. Thank you very much.